So Peter asked me to talk about syndication. Syndication. It's an evil-sounding word to me, anyway. I mean, when I grew up, when somebody talked about the syndicate, it was like Al Capone. I mean, VCs, we already have an image problem, so who the heck decided to call them syndicates anyway? I mean, start a poll and a movement to change the name to investment teams or investment co-ops, because I've already got an image problem as it is. So syndicates are what they're called, and I guess that's what we have to live with as a name. So I'm going to talk briefly here, 15, 20 minutes, and then open it up to questions. And let me start right off with the topic of syndication. Well, wait, should we move back? Let me start off with why do VCs syndicate versus angels? Why do VC funds even want to syndicate? First of all, it's not the case that VCs always syndicate. There certainly are cases where venture funds will decide to say, we're going to take the whole round. But most of the time, you'll find that venture funds, when they invest in an investment round, they will have at least one or more co-investors with them to form an investment syndicate. And the drivers behind having co-investors in an investment syndicate stem from the limit on the fund and how much they can invest in the round, same as an individual investor. There is a range and a limit depending on the stage and size of the company and size of the fund on how much each fund feels is appropriate for them to invest in a given round. If the company's raising $5 million and your limit is 2 or 3, obviously you need co-investors. So one is to get enough money around the table. Another one is financing risk and to decrease financing risk. This is an important one. I'll talk about this more later when I talk about VCs syndicating with angels. And what I mean by that is, however much we would all like all of our investments to do phenomenally well from the beginning, anybody who's done early stage investing knows that is actually the exception, not the rule. The rule is that most companies are going to go through some rough patches. And when they go through rough patches, they may need some additional capital at a time when outside investors might not be so excited about investing in the company, or at least not at a price that the inside investors would like them to invest at. And so that requires the investors in the company to reach into their pocket and write another check. And so when I talk about financing risk, that's as a VC what we think about is having syndicate partners decreases our financing risk in the scenario that we have to have a bridge round to get to the next round of investment with a new lead outside investor. If we're the only investor in that round, guess who's going to have to write that entire check for that bridge round? It's going to be our fund. So financing risk is another key reason that venture funds will syndicate. The third reason is brain power and people power. More people who are invested in the company, the more brains around the table to help think through and solve problems, and the more connections that are available to the company. Obviously, an investor in a company is going to open up their contacts and their relationships to help that company grow. So there is a benefit to having more investors at the table who bring the ability to help the company grow. And then the fourth reason that VCs syndicate is deal flow. Deal flow is a currency in the venture capital industry between VCs, and like most entrepreneurs realize, VCs do sometimes compete with each other, but it's much more of co-opetition than just straight out competition, because VCs cooperate at least as much, if not more, than they compete with each other by trading deals, working together on deals. And so when we have an investment that we're going to make, if we bring a good opportunity to another venture fund, that's a good thing, because guess what? They might bring an opportunity back to us in the future. They may be there to help us out in another deal, and that is the currency in which the venture industry works. So that's the high level of why venture funds syndicate. So let's talk about syndication with angel investors. Most VCs, I would probably say all VCs, have syndicated with angel investors before, because most VCs invest in companies that raised angel money prior to the VCs coming in to do a round. There are certainly some exceptions to that, companies that raise venture money right out of the gate and never have any angel investors involved, but those are definitely the exception to the rule. So by and large, when VCs come into a round, there already are angel investors, and it's not uncommon that some of those angel investors may want to write an additional check into the round that the venture funds are funding. Most VCs are usually okay with that. It's usually a small amount of money. It doesn't really affect the round. and we don't want to make waves or get anybody upset, so we're certainly typically will allow those angel investors to add on to their investment, and therefore they are in the syndicate for that round. So the thing I would distinguish between is that scenario versus the scenario of an angel investor being a meaningful part of a round. Meaning, if you're putting together a $3 million round, an angel investor writing individually a $500,000 or $1 million check. That is a much less common occurrence. Obviously, it takes an angel with a much higher net worth to be able to write that type of a check. But that does happen. We've co-invested with angels who have written those size of checks before in our history. And how we view angel investors who invest alongside of us is different than how we would view a venture fund. And the reason for that is, especially that first category of angels that are writing smaller checks, is back to the financing risk. We can't count on them. We cannot count on them to be there during the tough times. In fact, most VCs with smaller angel investors will presume that they won't be there during the tough times. That if things get tough, they will not write a check and we will have to carry the freight. And so, while most VCs aren't going to oppose angel investors who are in the deal and who want to add on, most VCs won't oppose that happening, we don't view it as a positive either. It's kind of a neutral because they really don't help us out much in terms of de-risking the deal. For that smaller category of angel investors who can write larger checks and this is an important have a track record of investing in early stage companies over and over again. They understand how it works. We can and have viewed them in the same light that we would view a venture fund co-investor because we really feel like we can have confidence that they will write another 100,000, $250,000, $500,000 check as part of their pro rata if there needs to be a bridge round. So those smaller category of VCs can be ones that we view in that same light. And is important because we certainly had cases where there was a big angel involved in a company. It might have been the uncle of one of the founders, and that uncle made all their money in the real estate industry. I use that as an example. Are there people with real estate backgrounds, real estate industry? Okay, so I apologize for offending you in advance. But the reality is that most people from the real estate industry, my brothers are both wealthy in the real estate industry, so they fall in this category, are really not good angel investors. And so a wealthy uncle who might be worth $100, $200 million and can write the check, we still would view probably as that same category of smaller angels, meaning we can't count on them to be there because they don't understand that kind of process and thinking and building a company. In the real estate world, you don't break ground in a building until you have all the money lined up, and then you build the building, at least in this country. If you've been to the Caribbean, they don't do it that way there. They build buildings in the Caribbean the way we build companies here, right? So real estate investors in the Caribbean might be good investors in startup companies, meaning we invest a little, we see how far we're gonna get, and we invest more, and we see how far we can get, and if we run out of money, we stop building the company, right? That's how they build buildings in the Caribbean, but not here. So real estate investors, no matter how wealthy, are a little bit tough. So the and is very important. Very wealthy individual who also has a track record of investing in early stage tech companies. They understand the process, the rhythm. They won't be shocked, surprised, dismayed if there has to be a bridge round to get the company further along to its next round of financing. And so we can count on them to be a strong syndicate partner. So let me turn to the structure of angel investments and how that impacts syndication. I would say that, first of all, the structure of the angel round is more likely to impact the ability to raise a round at all than syndication per se. But where it can impact syndication and the ability to get a round done is, number one, number of investors. Most VCs are very insensitive to how many investors there are in the company. And this is where things like crowdfunding can fall apart if not done correctly. Having 100 investors on your cap table is not something most VCs will touch. There's just too much risk. It's too complicated to syndicate the deal, to get approvals. And it's something that persists. It's not just a one-round problem. It's going to go on for the life of the company. So having too many investors in the deal can complicate it. Forming single-purpose LLCs is a great way to help resolve that issue because it acts as one entity, and one investor in that group cannot screw up the investment for all of the investors in the company. Complicated deal structures can make it very difficult to get the round done and can make it difficult to syndicate the deal because other investors may not want to come into a company where the angels have put some complicated structure together in getting the deal done. Corporate structure can be an issue. You're probably aware most VCs are going to force a change to a C Corp. If there was not a willingness to do that and the company wanted to stay in LLC or whatever form it might have, there are certain VCs that wouldn't do the deal because it becomes very complicated for VCs to invest in companies that aren't C Corps. I'll save the why of that for a different talk, but there are a lot of reasons why that's complicated for VCs. So let me finish with a topic that I think is often overlooked when it comes to syndication, and then open it up for questions. And that is selecting your syndicate partners. Presuming you have the ability to actually have some optionality about who should invest in the company, it's important to think through who will make the strongest investment syndicate for the company. And the factors aren't just money. The money's all green, so it's all the same. It's actually a commodity, right? It's completely identical. Whether you get $1 million here, $1 million there, it's the same $1 million. But what is different is what those individuals bring to the table besides their money. Their knowledge, their experience, how they can be able to help the company grow, their connections, their contacts, who else is in their firm or organization, how are they going to help the business to be able to grow and break through in important areas. And then last but not least, and this is, I would say, the most overlooked thing, very few entrepreneurs think about this, is alignment of interests of the investors. Alignment of interests of the investors, and there's this presumption they all want to invest in my company, they must all want the same thing, and they don't actually vet that thesis, that they all want the same outcome and the same process and think the same about how to grow the business. And I'll use my personal example. I was a dot-com entrepreneur. I've been on the other side. I raised over $25 million in capital for my company during the dot-com days, angel, all the way through VC. And when I was going out to raise my first VC round, I had already raised angel money. That day it was obviously a great time. There was a lot of interest in the companies, and I did have options. And I had 2 VC funds that wanted to invest in my company as a syndicate, and I had a billionaire in his family office that wanted to take the whole round. And I liked them both. And I said, the VCs can bring me this in terms of their connections or knowledge, and then the billionaire has a lot of interesting assets and resources that he can bring, and I thought, I'm going to have my cake and eat it too. I'm going to structure this around, I'm going to bring them all together. And I was an entrepreneur, so I'm pretty good at getting things the way I wanted them, and lo and behold, I got that done. And I got all of them, 2 VCs and the billionaire as the investors in my company. All of them had board seats, so there were 3 board seats among them on a 5-person board in my company. What I didn't do was to talk to them about, how do you think about growing my business? What's your desire for my business and the outcome? How do you think about burn rate versus growth? And lo and behold, there was not alignment. There was not alignment between the 2 VCs and between the $1 billion angel investor. This billionaire was self-made. He built his companies from the ground up. He made his billions starting by taking failing manufacturing companies and turning them around into successful businesses. His view was the long haul. Now, VCs are long-term, right? But VCs have a limit to our time frame. He didn't have a limit. Angel investors don't have a limit. He wanted to help me build a great company, and it didn't matter if it grew a little slower with a little slower burn rate. In fact, burn rate scared him, and the VCs and him were completely in misalignment on high burn rate, go for as much growth as you can. This is the dot-com days, right? It was crazy. Versus, let's moderate this and go a little bit more thoughtful about how we move forward. Created an enormous amount of tension on my board. Created an enormous amount of stress for me, and put me in a position of having to decide on the path that I wanted to follow, knowing that I was going to make at least one of my board members unhappy, or split the difference and make them all somewhat unhappy. So it was a very challenging situation for several years. and something that I learned from, and again, one of the key things I would give all investors investing in a deal, and this can be true even among angel investors coming to invest in a company, is understanding and having a discussion with your co-investors about what's our goal here. Are we in this for the long haul? Are we trying to go for a 2-year quick flip? Is the goal to reach these milestones and go out and raise a venture round, understanding that the venture guys are going to want to try and grow this company fast over 4 to 6 years and get it to exit either through M&A or an IPO? What are we trying to do here? How do we think about the business? Are we reasonably aligned that we're not going to be fighting with each other over strategy in the company? So I'll close with that and open it up for questions. Somebody have a question out there? Peter has a question.
And the conflicts that occur there. So I have 2 questions really, and this has to do with when when we put together an angel syndicate, we will usually take a board seat, and then when VC comes in for a Series A, then there's usually either a board expands from 3 to 5, or that board seat gets replaced. So that's part A. And then part B, when you are syndicating, how do you decide who among the syndicate partners will get that board seat?
So the first question was about board structure, right, Peter? Okay, and obviously every deal is different in terms of board structure, but it's the most common in a Series A round is that there's going to be a board seat for the common shareholders. Sometimes there'll be a board seat for the CEO and the common shareholders. And so whether an angel investor ends up being the board representative of those common shareholders has a lot to do with the cap table and how much they own of the company, and whether they control enough to do that, to designate that member, and the CEO's desires. Because usually the CEO and the founders of the company own the most common stock, and so it's who do they want to fill that seat that often drives that. And I didn't understand the second question exactly. You're saying when we don't syndicate, then
just later on, it's just you and other VCs syndicating. How do you decide?
Oh, when it's us and other VCs syndicating, how do we decide who has the board seat? Well, number one, the golden rule. You has the golden rules. Whoever's writing the biggest check has obviously ultimate say in a lot. And you know, how much say that is based on how well the company is doing. The better the company is doing, obviously the more control and optionality the company has, because it doesn't have to take that investor's money, it has choices, and so if it doesn't like the board structure that's being imposed on it by that VC, it can say, sorry, we're not going to do that, and walk away. So those are a couple of things that can affect that dynamic. And then the prior investment documents have some implication on that, depending on how the rights and preferences were written in the earlier rounds of stock with respect to the board seat. That could provide protections for the early investors with respect to keeping their board seat. That doesn't mean that can't be negotiated away, but at least it has to be a negotiated item at that point. It has to be discussed. They can't just come in and say, we're going to do this. They have to say, we're asking you to waive your right to the board seat, and it becomes a discussion and a negotiation. In most, if I look at the bell curve, in most Series B rounds in particular, most of the time what happens is that you'll have one lead VC come in and they will get a board seat, and the board will either expand, or you may see some shifting with the earlier investors, with one of them going off to an observer role. That's typically what happens. Usually the Series A VCs stay on the board through the Series B and C. Sometimes when you get to the Series D, that can start to change with the Series A investors. They may, especially if there's more than one representative from Series A, they may ask to consolidate that into a single seat.
Yeah, I'm an entrepreneur. This may be related to micro VCs, maybe smaller, with $35 million funds to $90 million funds. How do you, These micro VCs may have just 2 or 3 partners, so they're quite busy working on Series A deals. But when it comes to much early stage seed funding, I hear that they may want to invest smaller amounts and participate with angels. But I'm not quite sure, what is your experience with what kind of participation the micro VCs will make? Would they really be on the sidelines, just putting $50,000, $100,000 down and not pay too much attention until possibly a Series A opportunity arises for that company?
And so there isn't a monolithic answer, right? I mean, it's a bell curve of how different firms will address different stages of investment. Clearly, the earlier you get in companies, the fewer the VCs there are VCs that would even look at the company. So when you get down to a seed investment, you're talking about a pretty small sliver of VCs that would look at a true pre-revenue, we just have a business plan idea investment. There are some firms out there that I'm aware of that have sort of a portion of their capital allocated for doing seed investments where they make micro investments, 100, 200, 300K. And I've seen firms do that where they do it on a sort of passive basis. They pick deals they like very quickly. They throw in 100 or 200 and they actually don't take a board seat at the seed. And then there are firms that do seed investments where they only make larger investments, $1 million, $2 million into those companies, and they want to be very involved. So it's a spectrum out there. I will tell you that absent that first category of the very few firms that do sort of these small investments with low engagement, what you'll find in the seed stage is most VCs, if they will do seed at all, will only invest in seed companies where they have a pre-existing relationship with one of the founders. There's some connection, they've known one of the founders, previously invested in them before, knew in a previous company that they invested something, where they feel like they have less management risk. And they're willing to bet on the management. That's, if you looked at the deals and you actually had full information, I suspect when you see a VC writing a meaningful check into a seed round, that in 80% of the cases, that connection was there.
Hey, this is just a curiosity question, but when you were addressing your personal situation with working with Sorry. David, this question is in regard to your experience with working with the billionaire and the two VCs. I'm just curious, did you take certain action to modify your progress in the company to try to keep the peace between your board members? Or did you go ahead and take action regardless of how it was going to affect the board?
Well, I mean, I had to make a decision on what to do. So, the answer is it changed over time, right? Because it wasn't a single point in time decision. Earlier on, I tended to gravitate more towards what the VCs wanted to do. And we, like a lot of .com companies, were on a somewhat higher burn rate. Thankfully, I didn't go as far as they wanted me to go. And because of that, the company made it through the crash and came out the other side a smaller but cash flow positive company. And I don't know that would have happened if I would have just done what the VCs wanted me to do in that stage and burnt as much capital as they wanted me to burn. And then after the crash, it was really all about, it was a complete shift, obviously, thinking. Actually, the crash brought around alignment on my board. It's kind of nice to say, hey, I don't fight my board anymore. Everybody's like, conserve cash. We're all in the same boat. But the short answer is, I didn't go completely in the VC's direction, but I erred on that side of the curve. I certainly was burning more than my billionaire would have liked, but I was burning less than what my VCs would have liked.
Thank you.
Yeah.
What type of companies access venture invest and how much?
What kind of companies do we invest in and how much? So we can invest in any technology-based business. So we're not limited. We won't invest in real estate. We won't invest in publicly traded companies. And anything that's technology-based. Most of our investments, probably about 80%, end up being IT-related, broadly defined. So software, hardware, web, mobile. And that's just because, like with most VCs, those companies tend to be able to meet the venture profile of ability to grow fast with fat gross margins and ultimately get a generous multiple on exit in the time frame that fits for a 10-year VC fund. But we've invested in nanotechnology companies, smart grid companies, LED lighting companies, so we've done a variety of things. We will invest out of the current fund up to $2.25 million in the first investment. A lot of our first investments are $1.5 million to $2 million. We'll make investments as small as $100,000 on earlier deals, and have done the full range out of this fund. And then reserves behind that for follow-on. Typically, we put $5 to $6 million total in our winners over multiple rounds. Go ahead, just be loud. I'll hear. We'll get it.
Besides limiting the number of entries on the cap structure, what are some things you wish angels would look at more frequently here in Colorado that would make deals attractive to you?
So the question was, other than the number of investors in the cap table, what do I wish angels would look at more carefully to make deals more attractive to us? Honestly, I would say most deals in Colorado are being done with capped notes and uncapped notes, and those are great. They're very clean, they're very simple, and so keep it up. I mean, those are the things that make it really easy for any investor to come into the next round. The main things that when I do see problems to avoid, the biggest one is they price around and they overprice it. And so, we're faced with telling the entrepreneur, you might be interested, but you're going to have to go back to your investors and tell them that we're not going to invest at that price, and you have to decide how you're going to make that right with your investors. Are you just going to stick it to them, or are you going to try and give them some anti-dilution protection, and you have to work through it? It's just a whole other complexity to have to go through securities. So that's the biggest thing is when angels come in and didn't understand how to price the round. And so that's why the notes and the cap notes are definitely the best way to go. It's the right protection for everybody.
Hi, David. In talking to a number of the entrepreneurs, both here and other ones I advise, I think there's a tendency at the pre-capital stage to want to avoid dilution to the extreme and take as little as they can to kind of show progress before they talk to you, and minimize the round size and focus on that maybe too much at the early stages at the expense of getting back to work and getting all the capital you need in hand and looking longer term. I'm just kind of curious if that's your experience, what you advise people for their first round, getting more than you need for the bumps ahead in the road and not worrying too much about dilution, or if you think that's a valid strategy to keep being out in the market, getting little bites all the time.
So, I always counsel entrepreneurs that you're always going to need more capital than you think. So, in general, if you're going to err on the side of raising more if you have the opportunity than less, because you're going to need it. And ultimately, if you're growing a successful business, the extra dilution you'll take at the end of the day, what's most important is actually having a valuable company. Then the optionality around saving an extra few percent of the company for yourself. So in general, I'd say raise the extra money. I also would say most entrepreneurs, first-time entrepreneurs at least, don't think about how much capital that they should raise in the best way. They tend to think of it very focused on dilution and cap table. That's their focus. How much am I selling? When the real focus should be, how far can I get with this amount of capital? What can I accomplish in the company with this amount of capital? And what do I think that'll enable me to raise the next round at? What kind of valuation do I believe, when I talk to informed people, that if I were there today, I could raise that round at? And understanding how much you need to raise to make enough progress so that you actually can raise the next round at a very nice markup in valuation, or get to cash flow break even if that's the goal. Those are both acceptable goals. And that's the way we think about our rounds. When we say, a Series A round, we think about round size, we think about it in terms of, is this enough to make sufficient progress that we can get a significant step up in valuation? We target a 2x step up in valuation from the post money to the pre-money in the next round. And if it's too small, you just can't, it's not worth investing anything, right? I mean, if somebody's raising, to give you a ridiculous example, if it's a $100 angel round, I think everybody would say, well, this company's not gonna be able to do anything with this. Why would I waste my $100? So if it's too small, you just can't do enough to make progress in the company. Any final questions? I got about a minute left. If not, plug for the Venture Summit. The evening party of the summit is open to all angels, all founders and CEOs of tech companies at any stage. The main event is limited to VCs and essentially post-Series A, post-seed VC companies. But I encourage you all to go to the website and sign up for the party. It was a big shindig with about 300-400 people last year. All the VCs usually hang around for the first part of that party, so you can come in and meet the 40 plus VCs we had last year from around the country and all the CEOs of the venture-backed companies as well. So thank you very much.